Someone had to ask. I'm Amy Viaclia, and this show is built on one idea that good questions asked of the right people make all the difference. Each episode, I sit down with someone who has the expertise most of us don't and ask the questions you might not know to ask. Someone had to ask, so I did. Most people think of a mortgage as one thing. You either qualify or you don't, and the loan you get is the loan you get. That's not how it works. There are several distinct types of home loans, each with its own rules, its own requirements, and its own trade-offs. And which one fits you can change the entire shape of your home buying experience, from your down payment to your interest rate to whether you qualify at all. Jay Sills with Barrett Financial Group is with us today, and he works in four main loan groups: conventional, FHA, VA, and USDA. And every one of them exists for a reason. So today I wanted to talk to Jay to walk us through what actually separates them and how someone figures out which door is theirs. Jay, welcome back to Someone Had to Ask.
Thanks for having me.
Jay, before we get into each one individually, give us the big picture. When someone starts the mortgage process, how many paths are actually in front of them? And what's the broad difference between them?
Okay, so there's five different paths you can go with. Um, Whenever you're talking in terms of what type of mortgage you're going to be approved for and what those options mean. So it's conventional, which is most people know that or have heard that before, a conventional loan. And then there's FHA, then USDA, VA, and the new hot one right now is called non-QM, and it's mainly for investors, people that want to buy an investment property. It's a fantastic program, but you can also purchase a your own primary residence through what's called a non-QM, which that stands for non-qualified mortgage. So those have been really popular, but those are the five that I look at to see which one you qualify for, which one suits you best, and just go over what those options would mean for you.
Well, let's start with conventional loans, since that's probably the term people hear most. What defines a conventional loan and who tends to be the right fit for one?
Conventional loans, if you have okay, if you have 20% down, that the way to go is conventional. Um, just simply because there's no PMI. Now, with a conventional loan, there's other options you can on first time home buyer. You can do 3% down and 5%. 5% used to be the minimum for a conventional loan, but now with a first time home buyer program, you can put down as little as 3%. If you qualify, it depends on the area that you live in and the income that you make. You have to be under a certain income level as well. But 5% minimum on a conventional is a good rule of thumb to remember. Um, FHA is 3.5%, and the big difference between the two is FHA is a little bit more lenient on with credit score, and the interest rate is typically a 0.5% lower than a conventional. The only trade-off that's not all that ideal with FHA is their what's called their upfront mortgage insurance premium, which is 1.75% of the dollar amount you finance. So, you multiply 1.75% by the amount that you finance, that number is going to be rolled into your loan. So that's the big difference. FHA is a great deal. It's a good deal for a lot of people that maybe have had a bankruptcy. You're 2 years outside of bankruptcy, you're good to go. You can get a mortgage again. You just have to wait 2 years that from your bankruptcy being discharged. Um, and like I said, and the interest rate is lower, even with a lower credit score. So it's FHA is very ideal for a lot of people that have maybe had some credit issues in the past. So whatever the circumstances are, but um, VA is also good, but you need to be a veteran or in active military. USDA is probably my favorite. No money down loan with along with VA. USDA is awesome because their interest rate's low, PMI is low, but you have to fit in a certain box for USDA. You have to make under household income has to be under 119,000. It's 119,000 and some change. It's like it's some weird number, 119,800 or something. But so as long as you make 119,000 under as a household income, and it has to be in a more rural area. So we just looked the property address up before we even run the approval. Um, and then did I already mention? I think I already kind of hit on non-QM. That's a little bit more of an outside the box type of mortgage, and but it's a good alternative for self-employed people. That it's actually perfect for somebody self-employed because you don't have to show your tax returns. You can go off of what's called you can do a bank statement loan if you're self-employed. So I get self-employed are the hardest people to get approved or used to be because you could talk to a self-employed person and say, and they will every single time. I'm telling you, in 23 years, it's never been any different from any time I've ever taken individual tax returns from somebody self-employed. They'll tell me how much they make, which I already know. They're telling me the truth. I don't think anybody's ever lying to me technically, but they write off every single penny. So they tell me over the phone, yeah, I mean, I had a good year. Last 2 years, I've been a little over 200,000. Great, awesome. Whenever I get the individual tax returns, it'll show 13,000 because they wrote off everything. So I know that you made $200,000. I get it, but you're paying taxes on 13,000. So that's what we have to show you made as a self-employed individual. But a non-QM loan, bank statement loan, we just add up the deposits and we figure your income that way. It's perfect for somebody self-employed. So it's just again, like we've been hitting on these episodes. It's everything is situational. What's good for one person, your next door neighbor, best friend, even could apply for this, a mortgage at the same exact time. But you all might have two different mortgages that might fit because it's the situation that might fit for you, might not fit for them, and that's why a good loan officer, me, can tell you you need to go the FHA route. You need to go the conventional route, and here's why. So.
Well, let's talk about conventional a little bit longer. You mentioned it's a great loan for 20% down, but you can have as little as
Mm.
3% down, but then there's the PMI. Could you just explain PMI and how long it exists on a loan? When do people climb out of that PMI hole?
Private mortgage insurance. It's always been a nasty little thing that's it's been tagged to a mortgage that people hear, and of course nobody it wants to pay extra, but PMI just protects the lender in the case that you default. That's all it is. It does not help you in any way. However, I believe PMI this year in 26 was brought back where you can deduct the interest. It can be deducted along with your interest. I need to double check that. It seems like I saw that in 2026 that was coming back that you can write off PMI. So it's not an all just awful thing to have PMI, but if that's the case, if you can write it off. But PMI generally lasts until you have 20% equity in the home. Okay. So, on a conventional loan, whenever you pay down your balance to technically 22%, you pay down a little bit more, it'll drop off automatically. Now you can refinance and get an appraisal at any time to get out of PMI. If you know your home value has gone up, you can refinance and get out of PMI that way. Because we can use the new appraised value. Say you bought your house and it appraised for 300,000, and 2 years later, it's worth 315, just by sitting there for 2 years. So you can refinance and get out of PMI maybe. Um, and so but it typically, not typically, it does. You will have PMI until you have 20% equity in the house.
Excellent. So let's dig into FHA loan. You talked about the difference, and perhaps you've had credit issues in the past, or uh, other situations. Now, is this loan mainly for first-time home buyers, or can anyone apply for that depending on their situation?
Anyone. FHA is good for first-time home buyers as well as multiple home buyers. It just comes down to your really how much you're putting down. If you want to put down the minimum, I would go with FHA more times than not, just because the interest rate's lower, and the PMI isn't too bad because it's set at 0.55%. Conventional, it's factored in. There's other factors that goes into your PMI, and it can be higher. Um, so if you have a lower credit score, say 650, and that's not even a bad credit score. I don't want to sound like 650 is like, oh, that's just terrible. It's not. It's just in a kind of a middle of the road uh, area. But you're with a conventional loan, your PMI is going to be higher, versus going with FHA. It's just going to be set at 0.55. It doesn't matter. It doesn't matter what your credit score is. If you qualify for the mortgage, that's what your PMI is going to be. So that's the advantage there. Um, and I forget where we were with my question with you, but that was the difference between conventional and FHA. Um, aren't that vast as far as payment goes. It's just, the PMI. If you want to reaching that milestone of having 20% equity, that's where you want to go with conventional. And with FHA, you have the tacked on upfront mortgage insurance premium that's financed into the loan. So you're financing more money um, with FHA. But both are, both are good options. There's even if you have perfect credit, depending on your situation, FHA might be the better route. You might want the lower interest rate um, versus conventional because it's roughly a 0.5% higher between
Okay.
conventional and government.
So, in a previous episode, you were talking about how you were working with a VA loan, and the examples of the interest rate were way different than what I got on my conventional loan. But what actually makes a VA loan different? Like, what should someone who's eligible know about it? And including anything that surprises sellers or agents in a competitive offer.
With VA, there's no PMI. Um, it's no money down and no PMI, and the interest rate is lower. Um, Typically, same with a 0.5% lower than a conventional mortgage. Sometimes more. I mean, it's been more like three, 3/8. I mean, excuse me, the three. What am I trying to say? 0.75% lower. So over a 0.5%. So VA has its advantages, and then you don't. But to know if you qualify, you have to spend a X amount of time in the reserves or in the service. You get a certificate of eligibility. We actually order that for you, and we can do that up front just to make sure. We have to get what's called your DD 214, which just basically shows your profile of the branch of service that you were in, and then we can order your certificate of eligibility for you, and that way you can see that you have full entitlement, um, which allows you to put no money down if you choose so.
USDA loans are probably the least understood of the
Mhm.
four main ones. You've gone into that fifth one a little bit, but what are the USDA loans? Like who qualifies and where does that rule requirement actually start and stop?
Yeah. So USDA is a great loan. No money down required. Interest rates like a VA. It's super low compared to conventional. Uh, but you do have to fit in a box, so to speak. You can't make more than 119,000 combined household income. The property needs to be located in a geographic area that's more rural. And we looked that up on the USDA website. I just type in the address. You can do it too. You can go to USDA.com. You can type in USDA eligibility map, and you can do it the same way I do it. I literally just type in the address on the USDA website. It'll pull up on the map and it'll say it's eligible or not eligible. But you can also see, like ones that pop up that aren't eligible are it's going to be in a more populated area. Like let's say I'm in Bowling Green, Kentucky. There are still areas in Warren County, Bowling Green, that is can do a USDA loan, but it's only in certain areas of the county, and it's in the obviously the most rural parts of the county. Um, but most of your smaller areas, Brandenburg, that you'd be wide open over there for USDA. Um, so that's you just have to look it up on the map. But most rural areas um, are going to be eligible. There's been some smaller communities now that have grown so much that are now not rural anymore. Don't qualify for USDA. Like Gallatin, Tennessee, used to be rural down there. It's just 30 miles south of Bowling Green, roughly, and that used to be wide open for USDA, and it's absolutely not anymore. So because Nashville has just exploded, and all these little areas like Gallatin, Portland, like those little areas have become more populated as a result of it, and Bowling Green for that matter.
Yeah, it's really grown. Um, so if someone qualifies for more than one of these, say they qualify for conventional and FHA or conventional and VA, how do they decide which one actually makes sense for them? And I know it's situational. I know that, lots of things factor in, but if they are doing a pros and cons sheet and they're making a list of their situation, what are they looking at?
If you're going to be in the house long term, a minimum 5 years, but that 10 years, it's really 10 years is the mark. If you're going to be in a house 10 years, I would go with a conventional, uh, just because you're not adding on any financed amount that's required. USDA, I didn't mention that they charge 1% funding fee. So 1% of whatever you finance, then that's also going to be rolled into your loan. You're not paying for it up front, but it is financed in the loan. So if you're going to be long term, I would go with conventional, um, just because there's no funding fee. There you have a higher interest rate, but there's no funding fee. You're not having to finance more. Um, and again, it is absolutely situational with everybody. It's not. I wish that I could say for certain that conventional every time is the way to go. Just me in our conversation for now. Yeah, I mean, long term, it's better to go the conventional route. If you have money to put down, significant 10% or more, conventional is the route to go. If you have minimum down payment, minimum to no down payment, then government is your option. FHA, USDA, or the non-QM, which actually non-QM requires a bigger down payment. So really FHA, USDA, VA. If you have minimum down payment, though, that's probably going to be the route you should go.
So the last question that I have today. So what's the biggest misconception you run into with any of these loan types? Something that people come to you and they assume something that just isn't true.
Well, this might be another episode, but the one thing that the misconception is I want to buy the rate down and buy points. And, if because in most people's minds, like, oh, well, if I'm going to spend 2% to buy the rate down, then it has to go down 2%, right? No, it goes down in eighths. So, like, for example, if you were to buy the rate down by 1 point, your rate's gonna be at 1/4% lower. So instead of 6 1/4, you'll get 6%. If you want to pay 2 points, you're going to be looking at basically 5.75 in this example I'm giving. If your rate was at 6 1/4, whether it's not costing any money. But as far as the misconceptions between these loans, I'd have to think on that a little bit because nothing really sticks out. It's always about like how much money do I have to put down.
Mm-hmm.
And I guess the misconception is that people need to put down 20%. That actually pops up more than I can even imagine, to be honest. I'm really surprised, like today, that people still think that you have to put down 20% to buy a house. So that would probably answer your question. That's actually popped up more in the last 6 months, oddly enough. The impression was I thought I had to put down, 20%. Like, no, you can put down 3% if you want, 3.5, 5%, or possibly no money down if you don't want. There are no money down conventional first-time home buyer programs too. That's also called down payment assistance. That's a very, very common question as well, but it's all situational. It all depends. But the main takeaway I would say with your question here is the percent down is the biggest thing that pops up. How much do I have to put down? Because each loan program is a little different. FHA is 3.5, conventional is 5%, or 3% if you fit into a first-time homebuyer program. And you can get kicked out of that program if you make too much money. So it's not really fair sometimes for a first-time homebuyer if you make above 80% of the what's called area median income that we look up. So there's lots of guidelines that we have to be aware of and
Right.
relay because there's just a lot to know.
Wow. Jay, I think a lot of people go into this process assuming there's one mortgage. And what you've laid out today is that there are really several doors. And which
Mhm.
one is yours depends on your situation.
One thing I will add too, with these different types of mortgages, and this is what I've always enjoyed about the mortgage business, is that all of these mortgages, it's different. You can negotiate with every type of these loans. Mortgages, like whenever you think about going to get a car loan, or you go and get a credit card, whatever, you don't have really any say in the terms. Like you just apply and like, oh, okay, well, this is what it is. With a mortgage, there are so many options that you have to choose from. I just think it's great because you actually can negotiate your rate to a certain degree. You can negotiate your closing costs. I mean, there's lots of things that you can do that you can be in control of this loan. And as it turns out, it typically is everyone's biggest purchase, everything that they finance. And you actually have more leverage on your side talking with the right loan officer, and we can go through these options. So that's the thing to not be scared about and actually be excited about. It's like, okay, I can apply for a mortgage for a house and I can actually negotiate some of the terms. So that's something that I would advise anybody to do. If you're even thinking about buying a house, get pre-approved first and then know your options.
Oh, excellent. Listeners, if this gave you a clearer sense of which loan type might fit you, or a better question to bring to your own loan officer, Jay could be yours. That's exactly what this show is for. Next time, We will dig into discount points. We've mentioned those a few times and have said on a couple of different occasions that they could be their own show. Well, they will be. We'll talk about discount points, the misconceptions, advantages, disadvantages. So if you found this conversation useful, share it with someone who's just starting to think about buying a home and doesn't know where to begin. Next time, we're going to zoom in on one part of this decision, what it means to buy down your rate with discount points and how to know if it's actually worth it for you. We'll leave it there for today. Someone had to ask, so I did.